Interest income tax is the fee you pay to the government on the extra money you earn from lending your money to a bank, another person, or an entity. When you put money into a savings account, buy a bond, or let your money sit somewhere that earns interest, you are essentially being paid for allowing someone else to use your money. That extra money might feel small or passive, but in most countries it is still considered taxable income. And for beginners, this can be surprising because it does not feel like income in the same way a paycheck does, which leads to many people even ignoring it. And so in this video, I am going to walk you through it step by step in a simple and clear way so you can fully understand how interest income tax works. Let us start with the basics by figuring out what it is exactly. Interest income tax is the amount of money the government takes when you receive extra income from lending your money. This usually happens when you deposit money in a bank account, invest in bonds, or use any financial product that pays interest over time. When you place your money in a bank, the bank does not just store it. It uses that money to lend to others or invest, and in return it pays you interest. That interest is your earnings. From the government's perspective, that earning is no different from other forms of income, which is why it is taxed. For example, if your savings account earns $100 in interest over a year, that $100 is considered income. Even though you did not actively work for it, it is still money you gained, and a portion of it will usually go to taxes in a lot of countries. And so, to explain it in simple terms, interest income tax is a tax on the money you earn by letting others use your money, even if you did nothing more than keep it in an account. Now let's break down how interest income tax works in real life. First, let's talk about who pays it. Actually, anyone who earns interest income may be required to pay this tax. This includes people with savings accounts, fixed deposits, bonds, or other interest-generating investments. And in most cases, interest income is taxed in the year it is earned, not when you withdraw it. This is an important detail that many beginners overlook. If your account earns interest and that interest is added to your balance, that amount can already be considered taxable even if you literally did nothing with it. And you have to be extra careful because some banks don't even report it in the tax papers they send you, usually when the amount you earned in interest is very small. The calculation is usually simple and straightforward, however. In a lot of places, you simply take the total interest you earned during the year and apply your tax rate to that amount. Here's a simple example. Let us say you have money in a savings account, and over the year it earns $100 in interest. If your tax rate is 20%, you would owe $20 in tax on that interest. That leaves you with $80 after taxes. In some situations, the bank may automatically deduct part of the tax before giving you the interest. In other cases, you will need to report it yourself when you file your taxes. The details can vary depending on where you live, but the main idea remains the same. Interest is treated as income, and it is often taxed accordingly. There are a few key things about interest income tax that many people misunderstand. One of the biggest misconceptions, like I said earlier, is that you only pay tax when you take the money out of your account. But in reality, in many systems, interest is taxed as soon as it is earned, even if it stays in your account and you never touch it. So if your balance grows because of interest, that growth can still be taxable for that year. But another common misunderstanding is that small amounts do not count. People often assume that if they only earn a few dollars in interest, it is not worth reporting. But technically, all interest income is usually taxable no matter how small it is. Some people also believe that all savings accounts are tax-free. While there are special accounts in some countries that offer tax advantages, most standard accounts do not. It is important to know the difference because it affects how much tax you might owe. These misconceptions can lead to confusion, especially when you are just starting to manage your money. Once you understand these details, it becomes much easier to stay on top of your finances. Now let us look at the pros and cons of interest income tax so you can see both sides clearly. First, the advantages. One major benefit is that it provides revenue for the government. This money helps pay for things like roads, schools, healthcare, and other public services that people rely on every day. A second advantage is the concept of fairness. Interest income is a form of earning money, so taxing it ensures that people who earn through savings or investments contribute just like those who earn only through work. At least that's how many governments promote it. A third benefit is balance in the tax system. If interest income were not taxed, People might shift more of their money into interest-generating accounts to reduce their taxes, which could create an uneven system with potentially less money invested in other financial products that grow the economy like stocks. Now, when it comes to the downsides, one disadvantage is that it can reduce the incentive to save money. When your interest earnings are taxed, the actual return you keep becomes smaller, which can make saving feel less rewarding. Another issue is that it can feel discouraging, especially when interest rates are already low. Paying tax on small amounts of interest can make those earnings seem even less significant. A third downside is complexity. Different rules, exemptions, and reporting requirements can make it harder for beginners to fully understand how much they owe and why. So once again, there are trade-offs. Interest income tax helps support the system, but it also affects how people save and invest. Now, interest income tax can look very different depending on the country, and each approach reflects different priorities. Some countries treat interest income just like regular income and tax it at the same rates. This means the more you earn overall, the higher the tax rate on your interest. Countries like the United States and the United Kingdom generally follow this approach, meaning interest income is added to your total income and taxed based on your income bracket. On the other hand, some countries offer lower tax rates or special exemptions for certain types of interest income. They do this to encourage saving and investment, especially among individuals. There are also countries with very low or even no tax on certain types of interest income. Financial hubs like Singapore or the United Arab Emirates often use low taxes to attract investors and encourage people to keep their money within their financial systems. Then there are countries that try to balance both sides by offering tax-free accounts for certain limits, while still taxing other types of interest income. So interest income tax is not just about collecting money. It is also a way for governments to guide financial behavior and compete for investment. At its core, interest income tax exists because interest is considered income. If you earn money by letting someone else use your money, many governments consider that it still increases your revenue, and they include that in the tax system. Some consider that without it, people who earn income through savings and investments could end up paying less tax than those who rely on salaries, which could create an imbalance. And on paper, governments use the money collected from this tax in the same way they use other tax revenue. It helps fund infrastructure, healthcare, education, and public services that support the economy and society. Another reason it exists is to diversify revenue sources. Governments do not rely on just one type of tax. By taxing different forms of income, including interest, they create a more stable and consistent flow of funding. So, interest income tax is part of a larger system designed to keep things running smoothly while maintaining balance across different types of earnings. If you remember one thing from this video, let it be this. When you lend your money and earn extra money doing so, the extra cash is considered an interest. And that interest is taxed in many countries, even if you don't withdraw it and it just sits in your account. Now that you understand that, you start to see how even small financial decisions connect to the bigger picture of taxes. Obviously, if you want more specific details about how it works in your jurisdiction, make sure to consult with a professional in your area so they look at your specific situation. If you like this video, make sure to give it a like and then watch one of the videos showing at your screen right now. Alright, I'll see you on the next one.